Good morning, good evening, good afternoon, everybody. So we are going to take up the question, practical question for cost of capital, question number 3 in this particular session. All right, let's see. Here is your question. Practical question is here. What it is saying. Let's go through. ABC company's equity share is quoted in the market at 25 rupees per share currently. The company pays a dividend of rupees 2 per share, and the investor expects a market growth rate of 6%. You're supposed to calculate cost of equity. You're supposed to calculate cost of equity. This is simple. You can go ahead with using Gordon's growth model. This will be the simple task. What we are going to discuss is this question: calculating cost of debt. All right. So I'll show you step by step how to calculate the things. Okay. All right. Chaliye. So what question says all about? If the company issued 10% debentures of face value rupees 100 each and realizes 96 per debenture, while debentures are redeemable after 12 years at a premium of 12%, calculate the cost of debentures using YTM. Assume tax rate 50%. Prima facie, it will be very complicated to bifurcate the question. You will feel like a lot of things are there, how I should bifurcate the things properly. For that, what you have to do is, let's understand. First of all, do tell me, what is the face value of the debentures? And the interest rate? %. The interest will be rupees 10. Although you are receiving 96 rupees for the debenture, you have to pay interest on the face value itself. Do remember this. Later, it will give you tax saving 50%. It is savings, so it will be 5 rupees of saving and you will save 5. So net cost will be, it will be rupees 5. Fine. Next, now do understand, 5 rupees will be paid at the end of each year. Actually you will be paying 10 rupees, but because of tax saving, it will look like you are paying 5 rupees for next 12 years. So this is in the form of annuity. Alright, next. Now, what is the redemption value? Redemption value. Redemption is at 12% premium. Alright, 12% premium. So you have to pay 112 rupees at the end of 12th year. Okay. Now they are asking you to calculate YTM method. Say what is the cost of debt. Now YTM, that means you need to calculate IRR for the investor. Do understand? YTM is you have to calculate. You are solving for the purpose of company. You are gonna tell the company the cost of their funds. But while solving, you need to put yourself into the shoes of investor. Put yourself into the shoes of investor. Understand that you are the investor and what will be your realized yield if you invest in this debenture. Okay. Next. So IRR or YTM, where NPV will be 0. So you need to do trial and error. You need to have trials. So in the tabular format, how you are going to write is, for this purpose, for the purpose of valuation, you have to value the bond twice, the debenture twice. So for this purpose, formula will be looking like this. Formula should be like this: annuity multiplied by present value annuity factors are percent n years plus redemption value multiplied by redemption value, which is you're going to receive at the end of 12th year, 112 rupees, into present value factor r percent nth year. Clear? So combining this two, you will get value of the bond today, value of the debentures today. I'm going to solve this in tabular format. I'll put up a table, making sure the calculation goes very easy for both the trials. First of all, we'll be putting up this table here, particulars, cash flow, then present value factor at the rate, then discounted cash flow, then present value factor at the rate, and discounted cash flow. So first of all, we do this. All right. So there is tax saving of 50%, right? And the interest rate is 10%. So we should start with 5% or somewhere, right? Either 5% or below that you can start with. So first trial should be done with 5%. Let us do that. 5% present value factor. All right. Here I am going to write 0 to 10, 0 to 12. Sorry, 0 to 12. What you are going to receive is interest. That is 5 rupees, right? Working note number 1, last bit, that is E. Cool. In the 12th year, you are going to receive redemption value, that is 112. These two cash flows will happen to the investor. Okay? Now, how to calculate present value factors and present value annuity factors? Now, do understand what I have written here is this. What I have written in the table highlighted with green color is here, and the pink color is here. Done? Clear? Let's do. So, sir, how to calculate present value factors? 1 divided by 1.05. Step number 14 तक equal to दबाता चाहिए. Step number 14 तक you have to press equal to. On step number 14 you will find out this value 0.5568. On pressing GT you will be getting present value annuity factor 8.8632. that is being expressed with this 0 to 12. I have written the range. So 8.8632 is the present value factor. So I underline again this. Done. So as to connect the things, what things are placed where. Now multiplied by 5, you will get 44,316. Okay. And 0.5568 into 112 equal to 62.36, totaling 106.067. This is the value. What amount he is paying? On 0th day, what amount he is paying to you? 96. So for him it is the positive thing. 10.67 is the positive NPV for the investor, right? Now you need to do one thing. When you're discounting with 5%, it is giving a positive NPV. You need to increase the discounting rate. Let's try with somewhere 8%. 8%. Okay. So 1 divided by 1.08 is equal to till step number 14 again. So it will be 0.39711 GT 0.75360 into 5 equal to 37.68, and 0.39711 into 112 equal to 44.47 GT, 82.156, and he's purchasing at 96. It will give 13.84 negative NPV. Now that's perfect. Now we can calculate IRR. We can calculate IRR. What is the formula for IRR? It is IRR is equal to lower rate plus in bracket NPV at lower rate divided by NPV at lower rate plus NPV at. अच्छा, I was looking after, तुम्हारा ध्यान है कि नहीं है? हाँ हाँ हाँ, NPV at higher rate bracket में higher rate minus lower rate bracket close. Lower rate is 5% plus NPV at lower rate is 10.67, 10.67 minus 13.84 into 8%, 8 and 5, 8 minus 5. So 10.67 minus plus 13.84 equal to 24.51 divided by 10.67 divided by equal to into 3, that will become, shall write directly, 5 plus 1.305 is equal to 6.30%. This is the cost to the company. This is what the cost to the company for the given debt. Alright, clear? I believe I am able to illustrate the things, what amount on what amount you have to pay the interest, on what amount the debentures will redeem, and how they are being tackled down. Alright, clear? This is the most difficult situation they are making up for the question. Rest of the things, if there is no premium on redemption and all those things, question will be far easier than this. Okay? It should take not more than 5 to 7 minutes when you are doing on your own. Alright? If you like the video, if you understand the concept, please like the video, share with your friends who are looking after CA, enter financial management English to English. Will be very happy to deliver the sessions. Alright, thank you.